In this week's update, post-election outlook. Should you raise exposure to the US market? And what does it mean for Aussie resource stocks? And why did gold react so poorly? My name is Garry Davis. I'm an authorised representative of Primary Securities. Any advice is general advice only, and your personal objectives, financial situation, or needs have not been taken into consideration. What a week. An unexpected result in the sense of a clean sweep in the States, and the response from the market in America has been overwhelmingly positive. Now, I just want to go back to last week, what I said last Sunday. In the event of a Democrat win, expect to see benefit for the green revolution to accelerate. Infotech would be justifiably a winner from a Democrat win, and US infrastructure would do well. Of course, none of those things apply now because the Democrats didn't win. I also said that a Trump win was partially priced in, but certainly a clean sweep was not. And in the event of a Trump win, which has now been confirmed, I suggested that the areas that would most obviously benefit would be the military, domestic manufacturing, because of the way that he's going to structure the tax cuts, the construction and infrastructure area, financials from reduced regulation, and they certainly did have a very good week, pushing towards the US being the dominant energy producer, tax cuts, which is hugely stimulatory for the American economy. But no one was expecting a clean sweep. So what we have ahead of us now can only be described as a brave new world with, yes, certain things are clearer, and there are sectors of the US economy that are going to benefit enormously, but Trump is unpredictable, and it's very hard to know what the outcomes may be on a specific sector basis. But overall, he's got a mandate now, and a clear mandate from the public, and he's got no constraints for the next 4 years because he's not facing another election. So if anything, he's going to be even bolder than he was in the period from 2016 to 2020, and that could be a scary thought. But I suspect that he's going to be very much focused on the transition over to his current vice president. And so I don't think he's going to wreck the joint in the next 4 years. I think he will definitely have an eye to a Republican victory in the next US election. So we definitely have a brave new world on our hands. And as always, when faced with such things, don't burn up a lot of energy trying to pontificate about what might happen. Just play it as it comes at us with good, solid risk management is the best thing, and really the only sensible thing that you can do. All right, so what is now probable? So let's do a little bit of thinking about probabilities. Don't lock any of these things in as a given, but it's very helpful to understand what is probable so that we can manage reward for risk. Given the mandate that he's got, Trump can now actually enact his agenda. He's not going to get held up in Congress. So that would be the first thing. It's almost certain that US growth will accelerate, and there are things in his policies that will accelerate inflation. I don't think there's any doubt about that, particularly tariffs. However, there could be offsetting factors and offsetting policies that dramatically improve economic efficiency, and that may offset inflation. It's rather unpredictable, so I would not assume that significantly higher inflation is a given. I think that could be an error. It's highly likely that the drilling programs in America are going to expand quite significantly compared to the last administration. And so we're going to see a real ramp up in oil drilling and oil output. However, there's a bit of a timing issue here. Just how quickly will that surge in production occur? It's not going to happen overnight, that's for sure. That's just not how it works. Just because the new administration has got a certain policy doesn't mean that they can enact it and get private industry to move on it immediately. So I'm not expecting any massive short-term increase in oil production. But during this next 4-year term, we may well see a significant surge in oil production, which would, of course, put downward pressure on oil prices. And, of course, that helps to offset inflation in other areas. And then we've got tax cuts, which definitely favour domestic profitability. So that really brings small caps more into focus than previously. And we saw that with a massive rise in the Russell 2000. Severe tariffs on China and other countries, this is the part that's really unpredictable. There has been figures of 60% tariffs on China's goods thrown about. Whether they'll actually get to that level or not remains to be seen. Is it part of Trump's negotiating tactics? No one really knows. He probably doesn't even know, to be honest. So the tariff situation is definitely a wild card. And of course, how other countries respond to that. What does China do? Do they massively ramp up their stimulus? There is as many unknowns now as we had before the election. But I think the one thing that we can count on is that US growth is going to accelerate. And so that's a very significant positive for the US stock market. If inflation does ramp up significantly, then that may slow down the Fed in terms of their rate cuts. But it's very interesting that the day after the election, the Fed still went through with a 25 basis point rate cut. So they didn't hold off because of the election result. But it is possible that further expected rate cuts may not come through or may not come through in the time frame that was previously expected. We've just got to see how that one plays out. So it's a bit of a contest whether the rate cuts will come first or whether the growth in the US economy prevents the Fed from further rate cuts. It's a really hard call at this point in time, and one that really doesn't bear too much thinking about because it's in the unknowable category. But I think the one thing that will happen is there will be unintended consequences, and that's why trying to anticipate how things will be in 6 or 12 or 18 months' time is a futile exercise. Because Trump is unpredictable, there will be unintended consequences. It's just pointless. In fact, it's actually a negative, I think, to try and anticipate the future too much, because what that does is it plants a seed in your subconscious that just gets in the way of clear decision-making. So it's probably better just to forget about all that and just play it as it comes. In the immediate term, there are quite a few positives. The corporate buyback windows are open again, so the companies that are doing significant buyback programs can now do that. There were hedges in the market associated with the election. They will be in the process of being unwound. Has that been completed? Probably not, because these things take more than just a day or two to unwind. So that is likely to be a positive for the stock market. The earnings results generally are coming through fairly well. Some stocks are doing outrageously well, 40, 50% gains in a single session, but other stocks are getting absolutely murdered by similar amounts. So it's still very much a stock-specific environment. I think there is the expectation, if not obviously the reality yet, because that takes time, but I think there is the expectation that we're going to see even higher corporate profits because of the removal of red tape and just, all of the policies that Trump has espoused all work towards accelerating corporate profits. So I think that's probably a definite, and the market is perceiving that that's the case, and so it will move ahead of the event. The market won't be waiting for the companies to actually declare high profits. They're pricing that in right now. And then, of course, we've got November, December, arguably the two strongest months of the year as a bracket. So we've got end-of-year seasonality as well. Opposing that, if the bond market shot up after the election result, but did come back a bit on Friday. So how the bond market proceeds from here will be very interesting. If it continues higher, if yields continue to rise, bond prices falling, then that would be a drag on the positive sentiment for stocks. particularly technology and real estate stocks. China's response to the tariff war, that's probably important that they do respond with additional stimulus, but the dimension of it is the question. And just the final point that I would make is we saw Bitcoin take off as well on the election result because, Trump is favourable in that area of cryptocurrency. So I think the immediate term looks pretty positive. It's hard to argue against that. So where to invest in general? Let's look first of all in America. And these are just a few of the obvious areas. But again, this will not be a tide that will lift all boats. You still need to find the best performers in each of these areas. But I think overall, expect the unexpected. But small manufacturing, there's probably not much doubt. Small manufacturing is going to do really well. And the fact that the Russell went up as much as it did has already got that process underway. And there are just some absolutely fantastic small to medium-sized manufacturing companies in America in the range of sort of 5 billion to maybe 30, 40 billion market cap. There's a lot of them and they're doing extremely well and the share prices are reflecting that. And we've certainly got quite a number of those in the Insiders Club portfolios. Critical minerals, will they do well or not? Trump is not a fan of climate change and the green revolution, but he is a big fan of making sure that America is self-sufficient in critical minerals to obviously eliminate the leverage that China currently has through particularly things like rare earths for use in defense industries and all those sorts of areas and technology. So it's hard to know how that's going to play out with critical minerals. I think critical minerals projects in America are probably going to be favoured, but how that impacts critical minerals projects in Australia or Canada or wherever they might be is rather hard to know at this stage. The obvious answer is that it's uncertain, but I think one way to think about the opportunities is not so much those sectors themselves, but the companies that are actually servicing the growth of those industries. So the service providers to those particular sectors is probably a good area. And, going back to the old days in Australia, rather than being a gold miner, you were probably better off being a supplier to the gold mining industry in terms of picks and shovels. So I think the old picks and shovels analogy might definitely be an advantage. Oil and gas drilling, I don't think there's any doubt about that. It's going to ramp up significantly. So again, rather than investing in energy companies, because there could well be a lag there, but why not think about investing in the companies that service the oil and gas drilling industry? And then we've got data centers, of course. I think there'll be nothing in this election result that is going to inhibit the growth that we're currently seeing in data centers. So who are the service providers to the data centers? And that's a very broad church. Financials have already taken off because of less regulation. So that one was basically an instant success. And I think probably the strongest US sector once the election result was known. And of course, technology will continue to do well and smaller technology companies will be favoured by the new tax regime. And of course, crypto and associated investments. And there is even some discussion whether currently some of the current US Treasury holdings might in fact be invested into crypto. So that's a very interesting area to watch. And the final thing that I'd mention is I think it's probably highly likely that we're going to see a significant impact on housing, and that can only be good for home builders and also, again, suppliers to the housing industry. So there's just some thoughts on where some of the more positive tailwinds might be. If we look at Australia, I think in the defence area, I think the Australian government will be forced to increase their expenditure on defence. We are currently well below what is regarded at 2% as the normal level of investment that should occur in defence. And I think Trump is probably going to insist that Australia do more. And let's face it, we should have been doing more for a long, long period of time. So I think defence stocks could be one area that, again, the linkages there aren't necessarily that direct. Australian stocks that are supplying the US housing industry, stocks like James Hardie, might do well. It's not a recommendation, but it's just they're more likely to have a tailwind than not. Financials that have got significant US exposure are likely to do well also. Service providers to the energy sector, definitely not the producers. I've been very vocal for a number of years that I do not find the risk reward around Australian energy stocks at all attractive, Australian energy producers. But there are a number of service providers to that sector that I think can do very well. So there's some thoughts on perhaps where to focus. Now, as always, one of the reasons that this video gets done most Sundays and has been doing so now for nearly 17 years is that it's actually easier to lose money in the market than it is to make money. It's a risky place if you don't have a good game plan and a good process. So we strongly advise that you obtain your own investment, financial, legal, and any other advice you need before taking action. All right, let's turn to American stocks now. The S&P had a great week. A lot of it, of course, at the end, up 4.7%. The Nasdaq did even better, up 5.4%. But the Russell 2000 was by far the best, and it was up 8.7%. That's an enormous amount for such a broadly based index. And given the fact that it's smaller cap stocks, it's obviously a result of the Republican focus on making life better for domestic manufacturing. And then on Thursday, the Fed cut rates by 25 basis points, which sort of almost went through unnoticed, given all of the coverage that the election outcome got. It just got swallowed up in all of that other noise. But of all the comments that Jeremy Powell made, the one that I've highlighted here, which I think is the most important, is that he said he was feeling good about the economic activity. And that, together with the policies of the Republicans that are going to be net positive for domestic corporate profits, I think it's probably going to be a positive for the stock market overall for some time to come. So as I said to members over the weekend, stocks that should go up because of their fundamentals are now free to do so. So I think that's the way to think about the market. The US dollar was higher, almost back to 105. The 10-year yield did get up to above 4.4, but did ease back a little bit to 4.3. And the VIX, which was trading up around 22 at the start of the week, finished down under 15. So quite a significant change there. All right, there's the S&P on a weekly chart. Big week, up above 6,000 points, closed just a tick below it, but got above the 6,000 point hurdle. And just stand back and look at that chart. That is a very, very robust uptrend, and there's no reason why it can't continue. The Nasdaq, similarly, so it broke out after a bit of a period of underperformance when there was concern about stocks like Microsoft and Meta and their investments in AI. But we've now got new highs on the Nasdaq, and the Russell is the Russell 2000. Still got a little bit of work to do to get back above the November 2021 highs, but it's certainly it was already trending up, and last week was very, very strong. Semiconductors did okay last week, nothing out of the box. Certainly some other areas of technology did very well, but they're producing reasonably well. Now, if we look at it on a sector basis over the last month, what did really well last week? Well, consumer discretionary did well. That was a lot about Tesla and also Amazon. So Tesla was up 15%. Elon Musk, who is Trump's new best buddy. It's going to be very interesting because Trump is not exactly a fan of electric vehicles, and yet he's obviously a great fan of Elon Musk. So it's going to be fascinating to see how that dynamic plays out, particularly if Elon Musk has a role in the new administration. So, yeah, fascinating tussle there. Consumer discretionary did very well. Finance obviously did brilliantly well also. There was a bit of a pullback in communication services on Friday, but before that, they had done very well. And then we've got technology. Energy also spiked up quite dramatically in the States. So that was how things looked last week in America. If we look at Australia, information technology has had a huge rebound, a lot of that on the back of WiseTech Global rebound after this was the smashing handed out to WiseTech Global. And this is the rebound that information technology in general has been pretty solid all through. Finance did really well last week, as we'll see, and I'll look at the individual charts on the Australian market. Small caps kicked up, materials sort of somewhere in the middle, and then we've got healthcare and energy bringing up the rear. So let's just go to the Australian market. The Aussie dollar finished higher. Interestingly, even though the American dollar was up, the Aussie dollar also went up. Unexpected, given the downward pressure on commodity prices. So that's a real twister, that one. The ASX 200 was up 2.15% on the week. New record close for the Australian index. And resources led the way for part of the week at least. But if we look at resources, the tariff impact of what Trump does with China is a big unknown. What will that do to China's demand for our raw materials? And it's dependent a lot on what level of stimulus China brings to the table. So very hard to anticipate that one. All right, we'll just check in on the currencies. So there's the US dollar on a weekly chart. So it did move higher, but not by as much as I thought that it could. And hence the Australian dollar, we got a little bit of buying support on Friday. But there could be significant currency movements once the market makes up its mind about how all this is going to play out. We're heading now to the Australian market. There's the ASX 200 on a weekly chart. So a new all-time closing high. Materials, as I said, led the way on Friday. There certainly was some selling on Friday. So this is a daily chart. So it was looking very good at one stage, but definitely pulled back on Friday. So I think there's still a lot of indecision about what's going to happen with material stocks in Australia. But of course, this index heavily reflects BHP, Rio, Fortescue, and doesn't necessarily tell you very much about all the other smaller resource stocks. This is energy. Energy on a weekly chart didn't respond. It was down on the week. Not dramatically, but we've definitely got quite a significant downtrend underway in the energy sector. Finance did really well, very positive, closed right on its highs. Healthcare, pretty much in the middle. But it was information technology that did quite well. You can see on this weekly chart, we set new all-time highs. Now, I just want to make a comment in general, just on WiseTech Global, and I mentioned this last weekend, and I'm not making any particular recommendation about this. I just think the WiseTech Global situation is a great learning experience for investors, because smart investing is not about knowing what's certain, because nothing is. It's about balancing risk and reward. Now, the way that I look at a stock like WiseTech Global, which I owned and members owned until all the drama erupted a month or so ago. So I'm fundamentally favourably disposed to WiseTech Global and own it and profited from it. But the way that I look at it now is that when you're trading on a PE of 100 plus, which is where it sits at the moment, on the current FY25 forecast, and the growth forecast into FY25 is for 44% growth in earnings, then when you're trading on that sort of multiple, everything has to go well. The market will react poorly to anything that doesn't go well. So I look at WiseTech Global now, and I say, can I put my hand on my heart and say with conviction, will this stock continue with business as usual? And the answer is I cannot say that. It might continue to go up. It might be business as usual, but why run the risk? why not go somewhere where either the valuation multiple is much more reasonable or where the probability of nothing disruptive occurring is much higher? Why would you run the risk? So I don't understand this rebound. And I just use this as a flag for investors. When you've got uncertainty and you've got really extended valuations, it's probably smart just to look somewhere else. So that's the key point that I want to make. Turning to precious metals now, gold was down $51 to $26.85. So an expected negative reaction to Trump coming in, because there were a number of reasons for that I will get to. In Australian dollars, came off a bit, but not as much. We're still somewhere around the 4,100 mark in Australian dollars, which is extremely profitable. Silver did slip also down to 31.29. My view, based on probabilities, is that this was an overreaction. I don't think this is the start of the new downtrend. Yes, in the short term, it might go a bit lower, but I'm talking about a concerted longer-term downtrend for gold. I still think there's enough reason why gold could get support for that not to be the case, and I'll come back to that. Now, we are seeing continued strong inflows into global ETFs, but of course, though that data is before knowledge of the US election outcome. So that data that I'll show you in a minute is basically to the end of October. So it'll be very interesting to see what happens with the November numbers. If we look at gold stocks in Australia, gold stocks and silver stocks had an absolute shocker. On Thursday, they got absolutely smashed. But there was a bit of an indecisive bounce back on Friday. So the short term for local gold stocks is certainly a tricky one, that's for sure. There's a graphic from the World Gold Council on gold ETF flows. So you can see over the last 6 months, the inflows have been positive after having been outflows since the middle of 2023. So things have definitely turned around there. These are gold-backed ETFs, not stock ETFs. So certainly that is a dynamic that's been underway. Will this get changed by the election outcome? We need to wait and see over the next couple of months. Now, just a perspective on gold. So why the sharp decline? I think it depends on your time frame. Just the uncertainty of the election meant there was a premium in the gold price. So it didn't matter who won, that premium was going to come out of the gold price because the election was going to remove that uncertainty. So the gold price was always likely to come off to a degree just because of that. Now, Trump policies, I think it's safe to say, are going to tend to put upward pressure on inflation. That is going to mean bond yields are going to go up, which is not good for gold because of the yield effect. And it'll also obviously put upward pressure on the US dollar, which is not good for gold either. So on the surface, Trump policies are not good for gold. And it's also quite technically stretched as well, as we'll see in a minute when we get to the gold price. But let's look at the other side. What could provide support? We've had a trend, a very clear trend over the last couple of years where central banks have been moving out of US treasuries and buying gold. And I think that Trump's election, if anything, is going to accelerate that. So more central bank buying, even than what we've seen, is likely. The trade wars, how does that play out? What does that do to the perception of risk? Again, a big unknown, and big unknowns are generally positive for gold. The accelerating debt, probably little doubt that Trump will accelerate the US debt because that's how he does things. That's how he's built his business empire, on debt. And I think he will probably do the same thing with the American economy, try to drive growth through increasing debt. So again, accelerating debt. At what point does gold respond to that increasing debt levels? And if we look at the period from November 2016, so when Trump came to power the first time, to November 2020, when he went out of power, gold rose 67% and public debt during that period had risen 35%. Now, that's no guarantee of what will happen this time around. He won't necessarily ramp debt up that much, or he may ramp it up even more. Who knows? And how gold will respond to that. But I just make the point that there is a history there that the debt rose dramatically during his presidency and gold responded very positively. Now, we're coming from very different bases. In 2016, gold was not as technically buoyant as it is at the moment. So it's a very different starting point. But I'm just making the point here that this is not just as simple as Trump policies are inflationary and that's bad for gold because of the US dollar and bond yields. It's not that simple. There are numerous things that are positives for the gold price. So let's go and look at the gold price. We'll start with silver, actually. So silver, this is a weekly chart. We had a breakout, and then the last 2 weeks have been down. And you can see we finished just above $31. But we've still got an uptrend. We've still got higher highs and higher lows. Now, we don't want to come down and break below this level. So I think somewhere just under 30 is important support. As long as it's holding above 30, we're still in reasonably good shape. This is gold on a weekly chart in US dollars. So it certainly interrupted the trend that we had. That was a very powerful trend since the middle of the year. So that was the first significant down week that we'd seen in a while. And there's the gold price in Australian dollars. So a bit of a mixed bag in the end. If we put that on a daily chart, you can see a lot of indecision on Thursday and then a little bit of positivity on Friday. And just while I'm here, this is the Bitcoin chart breaking out. It's the daily chart. So breaking out once the election outcome was known, and the volumes are very significant as well. All right, turning to other commodities now. Copper hardly moved. Nickel was up very slightly, and crude oil was up a little bit as well, despite the rising US dollar. And as I mentioned last week, $66 is pretty crucial support. When we look at lithium, Trump promised to repeal the pro-EV rules, but what about Elon Musk? So there's a big unknown there. Expect some other changes with respect to the US IRA Act, but again, hard to know what they might be at this stage. So it's all about uncertainty. Now, turning to uranium, this is the slide that I put up last week, so I'll just cover off on what I said last week and then look at the uranium chart because there has been a big shift there. So I said the long-term fundamentals appeared to be strong, but the spot chart was looking very, very shaky. And tactically, it would be a good idea to think about putting some tight stop losses on any uranium stock investments that you had. Well, that's what's happened to the chart in the week. We've now broken down below that 80 level, got down to around 76, 77. So certainly things have not improved for spot uranium. There's the spot copper chart, not much change there, and similarly with crude oil. So wrapping it all up, I said last week flexible thinking was critical, and now it's even more critical because whilst some things are now more likely, there are many things that are also quite uncertain and will remain so because Trump is unpredictable, but he is also prone to changing his mind quite abruptly on things, and that can either be a positive or a negative. So it's very difficult now to feel certain about how things are going to play out in the States. Many new trends will emerge, so be alert to them, and portfolio composition may need to be significantly revamped in some areas. So the best thought I can leave you with is just to remain very open-minded. And of course, portfolio analysts coming is going to be very much focused on the financial world under Trump. Where are the higher probabilities going to be, and how do we go about managing through that period? So that's it. Fascinating week. I'm sure it won't be any different next week, and I'll be back with you next Sunday. Cheers.